Hi, this is Dan at Master Trader, and I'm going to respond via this video to Andre's question to us from our recent Master Trader live show. It's a two-part question that requires a lot of talking and showing, so here we go. Andre, thanks for watching and your comment. And his first question is, can you just answer for me again, why don't you all consider implied volatility when you're option trading? He says you can enter a trade during a low volatility period and sit on your hands until expiration and see your P&L turn red when volatility rises. So excellent question. The answer is we definitely watch volatility, Andre. We prefer selling high volatility on bullish patterns, and typically if you're going to get that high volatility, it's going to occur after a sell-off or some type of, it could be in the news and the volatility has spiked for one reason or another. So we definitely prefer that, because then when we're short options, we're short vega, which is the Greek that measures your volatility exposure. And when volatility contracts, we make money that way, in addition to being correct on the directional bias. And then time decay, of course. Those are the three components where we make money in high volatility environments. So right there, we definitely do. But would we sell credit spreads in low volatility environments? The answer is yes also, and here's the reason why. The majority of the time, we are in a low volatility environment, and selling our credit spreads around compelling patterns, we're still making a weekly and monthly paycheck, even though we're getting paid less than the net credit in a low vol environment. We're still consistently make money on high probability setups. So what we do to manage that volatility is with the charts. So if we do see volatility spiking, we just might kill the trade right there and not be the subject of a rising volatility problem, as you're mentioning. But the way Master Trader trades around the charts, that's typically not a problem, because if volatility is rising, that probably means the market and or possibly our stock of interest that we're in rather, is not acting as well as we hoped. So we would just kill the trade, and many times it would be at a profit because of the prior gains that we've achieved in the directional move, in addition to theta, which is the time decay income. So I hope that answered that one. The next question, I've seen you recommend a number of times low credit, and even if you, meaning I sell a spread and I'm not getting a big net credit. Let's just take an example. We typically, at a minimum, like 10% of the credit spread width with a compelling pattern, of course. So let's say we're selling a $5 wide bull put credit spread. So we want at least 50 cents, because that 50 cents divided by the capital required of $4.50 a share gives us an 11.1% return on capital. So maybe, I don't know what example you're talking about, but we only put on a trade if there's sufficient credit relative to our bullishness or bearishness of the underlying pattern, and saying the odds are staggering that we're going to keep this money, the credit received, even though it might be less than a high volatility environment. So I hope that answers that question. Here, I have the spiders up here. Let me just make a few comments here. So SPY is the S&P 500 ETF that we trade all the time. We love, 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 love selling short-term expiring put credit spreads in the spiders, short-term expiration, on sell-offs when volatility is high. This is measuring the implied volatility rank. So it's like volatility of volatility, and it's 79 here. It's ranked between 0 and 100. So yesterday in our green room, we actually sold an out of the money 269 put right here based upon calling a low for the day. It was a day trade. Greg sold his at 29 cents a share, so on a 10 lot, that's 290 bucks. They have multiple expirations throughout the week. So this is one of our go-tos. We love this. Let me show you, for example, what we could do. This is live market environment. It's 12:20 Eastern time on June 26th. The spiders right here are 271.93. Here are the quotes that expire tomorrow. So I'm just giving you an example. If we see that our confidence is going up, that we've put in a bottom, at least for today or yesterday, we would sell out of the money puts. Let's just take this 271 for example. So that's 98 cents out of the money. And if we sell a 10 lot of this at 56 cents, that would be $560 going into our bank account. And as long as it expires tomorrow at 4:15 p.m., because remember these ETFs, many of them trade to 4:15 Eastern, then we make that full profit. And then we have other management strategies, whether we stop out of it, roll them to the Friday expiration, something like that. We actually entered a out-of-the-money bull put credit spread on FedEx because of its massive sell-off. And these are for Friday's expiration. So the stock's at 235, and these are real numbers right now. We can sell an out-of-the-money 230 put, which is $5.28 out of the money, buy a 225 put, and this is what's called a bull put credit spread, 3 days to expiration, 55 cents a share. And so you tell me, Andre, does this meet my test of adequate premium? The answer is absolutely yes. It's $5 wide. I'm getting 5.5% of the spread width, so that's over 11% return on capital. It's a bullish master trader buy setup on an extended pattern. It is down multiple days to major support. It's down 1, 2, 3, 4, 5, 6 days, and it's in the news, trade wars, so volatility has spiked. But let's say hypothetically volatility didn't spike. I would take this identical setup, Andre, if I'm just making up hypothetical numbers here, if this were only 40 cents a share. If I had a compelling pattern, because 40 cents a share divided by $4.60 a share capital required is still a marvelous return on capital for 3 days of risk, provided, of course, you have a bullish bottoming pattern, and we believe we do on FedEx. I hope that helped. Happy trading, and look forward to your joining us for the next Master Trader Live, which is every Wednesday at noon Eastern. And don't forget to subscribe to our YouTube channel to continue to receive valuable information on trading and investing in the markets. Take care, Andre.